Hi folks, Vipin here. Today's topic is going to be debentures, and this according to me is one of the most interesting financial instruments there is. Now I say that because debentures, if you want to understand debentures, you need to be good at just your high school mathematics. Just the basic arithmetic is good enough for you to understand this, and that's what makes debentures so much more interesting, and in fact a very complicated contract at the same time. I know that sounds like a bit of a paradox, but let me try to explain why debentures are in fact so interesting. Now, we've all focused on equity. I would like to tell you, push the concept of equity aside and refresh your brain with debentures for now. Now, debentures are an acknowledgement of debt. Now, when the company issues a debenture, you call it just as a debenture, but when the government issues this, you call it as a bond. Either way, they're just the same. They are a loan which they take from the public. Debentures carry a coupon. Now, once upon a time, you had a debenture certificate which had coupons that were printed on it. Just like if you end up getting those Domino's pamphlets, on the bottom side you would find the coupons which would be printed on this. Now, when the coupons are printed there, how is it in fact related to debentures, you might ask? Now, that's a long time ago, wherein when you wanted to repay the interest to the debenture holders, you would do that by printing these coupons. If a debenture holder tore those coupons and submitted to the bank would repay the interest. On the coupon, you would have particular dates printed. Tear them on that date and submit to the bank would go about giving you the interest payment. Hence they call it as coupon. Today, coupon and interest rates are synonymous with each other. When you hear in the financial world a coupon on a bond is 4%, it just refers to the interest rate. Okay, and then debentures are issued at discount, or they can be issued at par. The only debenture I know which is issued at discount would be the treasury bills of Government of India. I'll just focus on Government of India for now. The Government of India issues treasury bills regularly. It's one of their methods to control credit in the country. So treasury bills happen to be issued at discount. When I say issued at discount, it's issued below the par value. Okay, if a debenture is sold at par, it means that the par value is, say, 1000 rupees. When it comes to discount, they issue it at, say, 990 or 995. Okay, par value is the one which is usually issued the highest when it comes to debentures. Debentures may carry attached collateral, which means when the company issues debentures, they associate the company's property with these debentures. Meaning they tell the investors that, or they give investors confidence that when you go about putting your money in our company, we will guarantee that your investment is safe by attaching collateral. When they attach collateral, it gives the investors the feeling that in case they're unable to repay my investment, they can sell the property and then use the money to repay my investment. When you have collateral attached, it just gives you the confidence to put your investment in that company. My opinion, I always invest in debentures which have collateral attached with them. They can be bought and sold just like equity. Yes, that's very true. In fact, there is a wholesale debt market in National Stock Exchange. But one reason why you don't see the volumes of trades in debentures like equity is because debentures don't really have a market in the secondary markets, you could say. The reason being, when you buy a debenture at, let's say, 1000 rupees, you can sell it only at 1000 rupees. Most people buy debentures because they want long-term returns and not short-term gains. So when you want to buy it, when you want to try and sell it, you can, but your loss here would be the commission. So people don't sell debentures even though they can. They keep the trading volumes limited. Principal is paid back on maturity. I'll get to that in some time. Debenture holders do not carry voting rights. There is a different meeting held for debenture holders altogether. Now, in those meetings, it's just a sake of formality that these meetings are held. If you feel something in the meeting which they say is something that you don't like, there is no scope for you to cast votes and say, I don't approve of this, I say no to your agenda, all that. So the meetings, like I said, are held just for the sake of formality and nothing else. Okay, and then principal paid back on maturity, I'll tell you that in a moment. Yes, why a debenture and a loan are same yet a little different. So what do I mean by that? Yes, I did confuse you in that, and that's for a good thing. Let me try to undo my mistake. If you see the blue part that has been put up there, the principal I've considered here is 10,000 rupees. Now let me explain this in the form of a loan first. If I've taken a loan of 10,000, the principal, I might have a rate of interest of 10%. I'm being very optimistic here. And I have to repay the loan in 5 years. So every month I would repay my loan in equated monthly installments. Okay, when the EMI is calculated, the EMI is calculated by considering both the principal and the interest payment. So I would arrive at a particular value. Okay, I would arrive at a particular value saying that this is the amount of money I add to my principal and this is the amount of money I add to my interest payment. When it comes to debentures, you don't do that. When it comes to debentures, the principal is repaid on maturity. As in 5 years from now, I'm going to get 10,000 back. But what about from now to the 5th year? From now till the 5th year, the next thing that's going to happen is the money that will come into my account will be the 1,000 rupees, which happens to be the interest payment on my debenture. The company repays the interest first, and then on the date of maturity, the principal amount happens to be given back. This is how in fact a debenture works. First the interest payment, and then you have the principal which happens to be returned. Who and why would people want to go about invest in this? So if you want to save tax, you would go about investing in debentures. Now why would you want to invest in debentures to save tax? Because debentures offer a very secure way in which you can keep your money. There are a lot of people who are risk averse, where I mentioned in point 3. If you want to keep your money safe and you don't want the government of India to start taxing on your income, the best way to save your income and at the same time avoid the government from taxing you would be to put your money in debentures. The most popular type of debentures in this would be infrastructure bonds or infrastructure debentures. Most of them offer a tax-free income. So when you put your money there, you get income, and at the same time you're able to avoid the government from pinching your pockets in the form of tax. Those who want regular income, now I mentioned here in the previous note that 1,000 rupees is given back to you every year in the form of interest payment. Now this is just a small amount that I've considered. Usually when people put money in debentures, they put in lakhs together at one go. So when you invest a large amount of money like that, over a course of time, you're able to earn very, very good annual returns, which is in fact in the form of interest payment. Debentures are also a way to hedge your portfolio. Hedging your portfolio means you try to control the losses on your investment. Now equity might give you say 20% rate of return. But what if the markets are not doing so well, like how it is going through right now? If the markets are not doing so well, your anticipation of 20% might be reduced to say minus 2%. But if you invested in your money in debentures, debentures offer you a fixed rate of return. This 10% that I've mentioned here is a fixed rate of return. So even though you could be losing 2% on equity, you are offset in terms of investing in debentures. Minus 2% plus 10%, you could get a good rate of return of around 8%. That's how you hedge your portfolio, by investing in debentures. When investors go about putting money in the form of hedging, the most popular hedge instrument would be Government of India or any government security. They do that because government securities are considered to be risk-free investments. Insurance companies too. Now where do you think your premium goes? when you invest in those various Bhima, Suraksha plan, something. My Hindi is bad. Don't want to talk about it. So the different plans of the different plans of LIC or any of the other insurance companies. You might have noticed in the insurance plan they tell you 5 years from now we'll give you so much money back, 10 years from now we'll give you so much of money back. The insurance company is able to calculate all that because they have used your premium and in fact invested in debentures. So even insurance companies do this because it offers a good rate of return and at the same time it keeps your investment safe. Moving on. Why does a company issue debentures in the first place? One, the interest paid to debenture holders from the company point of view happens to be a form of tax saving. Now, let's say I'm required to pay 25,000 rupees this year as income tax. If I show the education loan that I'm repaying or a housing loan that I'm repaying, the interest charged on these two loans, I can show the income tax department and reduce my tax liability. Just like that, companies can reduce their tax liability by showing that this is the amount of money we repay to our debenture holders. Debentures are more flexible than equity when it comes to utilization. What do I mean by that? When it comes to using equity, there is a law that says equity can be used only for a business activity. A business activity is one that generates revenue. I cannot raise money from the public and in fact use it to, let's say, put up swimming pools or give my employees a membership in Gold's Gym. That's not something that I can do. I can do that with debentures. In fact, there is a very bad business practice going around in India wherein companies like Airtel, even Reliance, they raise debentures to clear other debentures. Meaning they take a loan of say 10% or 8% in order to clear off a loan which is being paid off at say 10% or 6% or whatever. Raising a loan to clear a loan. Yes, you can do that with debentures. You cannot use the money from equity to repay loans. They are very strict about that when it comes to utilization. So this is what they mean when it comes to debentures being more flexible than any other instrument. Okay. Now I'm not sure how clear this particular slide is, but I'll explain a little bit from here. Firstly, you have the issuer, which happens to be Larsen Toubro Finance Limited. They happen to be issuing 500 crores worth of debentures. Okay. Now these debentures, in fact, if you come to the face value part, it says that the NCDs, the non-convertible debentures, will be issued at a face value of 1000 rupees each. Okay, so 1000 rupees each multiplied by how many is that? 50 lakhs. That's the number of 50 lakh debentures is what they want to sell, each at 1000 rupees. Security for the debenture will be there. They've actually mentioned that a debenture trust cum mortgage deed is actually been considered for this particular debenture. It's just to say that the debenture has been secured. Then a credit rating. A credit rating is given to show the financial ability or the creditworthiness of the borrower of this money. If Larsen Toubro Finance Limited is taking 500 crores, how good are they in repaying this? There is a rating of AA plus. AA plus shows that the ability to repay this is actually good and your investment happens to be safe if you put your money in Larsen Toubro Finance Limited. Then the tenure of these debentures can be 60 months, 88 months, 120 months as per the selected option. So you can select 5 years, you can select 88 months, it's up to you. Then additional application, okay, never mind that. The issue opens, they mentioned a date there. Redemption date 5 years from the deemed date of allotment, subject to the exercise of put option or call option. A put option gives the debenture holder the right to ask the company to repay their investment back. Let's say I've bought 10 bonds of Larsen Toubro Finance Limited by investing 10,000 rupees. Now 5 years from now, that's 2019, I can tell Larsen Toubro that I want my investment back by exercising my put option right. In the first case, a put option allows the debenture holder to request their money back. In the second case, a call option, the company can give the money back to the debenture holder prior to the maturity date. Now the reason the company does that is because they feel the funds have been utilized quite well and returns have been coming out very good. So why go about keeping the debentures for a long period of time when you can repay this right away? Hence the company could exercise its call option as well. Now this is in fact a short summary of how debentures work. I'll be working on another video which talks in a little bit more detail on the actual working of debentures, the way in which the interest rates are structured, and even more complicated debenture contracts which are there in the rest of the world. Thank you for your time. Do subscribe to my videos. Bye.